Hi, I'm Philip Garrett, Financial Advisor with Carmichael Hill, and in today's video, we'll be going over the ins and outs of required minimum distributions, otherwise known as RMDs. Let's get to it. Before we get started, please be sure to hit the like and subscribe button below so that you never miss an update. All right, so first things first, what are required minimum distributions? Well, the required minimum distribution is simply a minimum amount of money that you're required to take out of your tax-deferred accounts once you hit age 72. RMDs exist essentially because the IRS wants a share of the pie. See, because investors are able to enjoy tax deductions and tax-deferred growth throughout the years, the IRS has implemented RMDs to eventually force investors into a taxable event by withdrawing from their accounts. That said, there are ways to postpone, reduce, and potentially eliminate RMDs, which we'll get into later in this video. So which accounts have required minimum distributions? As mentioned, tax-deferred accounts like 401ks, 403bs, and traditional IRAs will have RMDs. It is important to note that RMDs also apply to Roth 401ks, which are tax-free. All right, so now that we know what RMDs are and which types of accounts they apply to, let's take a deeper dive into when we need to start taking these RMDs. So generally, you must take your first RMD by April 1st of the year after you turn 72. From that point on, you will need to take required minimum distributions before December 31st of each year. That said, there is a special rule that applies to workplace retirement plans, which allow plan participants who continue to work after obtaining age 72 to defer their RMD until April 1st following the year that they retire. It should be noted that this exception is not available for company owners or plan participants with more than 5% ownership in the company. Also, this exception does not apply to IRAs, as all traditional IRA owners must begin taking their RMDs by April 1st of the year after turning 72, whether they're working or not. Now, a question you might be wondering is, how do I know how much of an RMD I need to take out? This boils down to a simple calculation. The IRS uses uniform lifetime tables to calculate your RMD amounts. So to determine your RMD, you'll just need to decide what table applies to you, then take your account balance at the end of the preceding calendar year and divide it by the applicable distribution period from the table. This will result in your RMD amount. As mentioned, once the RMDs are in effect, you'll need to take out your required amount by December 31st of each year. Now, it's very important to make sure you don't miss the deadline, or the IRS will crack down a 50% penalty on the amount that should have been taken out. So for a quick example, let's say your RMD amount is $50,000 for the year and you only took out $10,000 by the deadline. A 50% penalty would then be assessed on the $40,000 you didn't take out. So in this example, you'd owe the IRS $20,000, and you would still be required to pull out the original $40,000, which would result in a taxable event. Now, there are a few ways to minimize your RMDs. By utilizing Roth conversions, one can move pre-tax money into a Roth IRA, which would reduce, if not eliminate, RMDs completely. A second option is for those of us with Roth 401ks. If you have a Roth 401k, before you turn age 72, you can look into rolling it over into a Roth IRA, which has no required minimum distributions. And lastly, for those of us who are charitably inclined, qualified charitable distributions, otherwise known as QCDs, can be a great way to reduce your RMD amount while giving tax efficiently. If you're interested in learning more about these methods, I've included a link in the description below. And if you're looking to reduce or eliminate your RMDs and are seeking help from a financial professional, or if you just have additional questions, please don't hesitate to give us a call. I hope you found value in this video. Thanks for watching. Till next time.